the world thought inflation was dead. After years of rising prices, aggressive interest rate hikes, and constant warnings from central banks, it finally seemed like the crisis was fading away. Prices weren't climbing as fast anymore. Energy markets had calmed down. Stock markets were recovering. And investors were starting to believe that the worst was behind us. Honestly, if you only looked at the headlines, you might think the story is already over. But here's the strange part. The people who spent years fighting inflation don't seem convinced. The Federal Reserve isn't celebrating. The European Central Bank isn't celebrating. The Bank of England isn't celebrating. In fact, many of the institutions that spent years fighting inflation still sound remarkably cautious. And that raises an interesting question. If inflation has truly been defeated, why are the world's most powerful central banks still worried? Because beneath the surface, there are signs that the battle may not be over. And to understand why, we need to step back and look at what inflation actually is. Most people think inflation is simply about prices, the cost of groceries, the price of gasoline, the rent payment at the end of the month. And while those things matter, inflation is really something much deeper. It's about behavior. It's about expectations. It's about what millions of people believe will happen next. Imagine everyone suddenly becomes convinced that prices will keep rising. Workers begin asking for higher wages. Businesses start increasing prices before their own costs rise. Landlords raise rents in anticipation of future inflation. Consumers rush to buy things today because they expect them to be more expensive tomorrow. At that point, inflation becomes more than an economic statistic. It becomes a self-fulfilling cycle. And that's exactly why central banks pay so much attention to expectations. Because once inflation psychology takes hold, bringing prices back under control becomes far more difficult. Many investors believed falling energy prices would solve the problem. And to some extent, they were right. Oil prices retreated from their highs. Supply chains improved. The panic that defined the early inflation shock began to fade. But inflation doesn't disappear the moment oil prices fall. In fact, that's one of the most common misunderstandings in economics. A fire may be extinguished, but the building remains hot long after the flames are gone. Inflation often works the same way. The original shock may fade, yet the effects continue spreading throughout the economy. Higher labor costs remain, higher rents remain, higher service prices remain, and central bankers know that these secondary effects can linger for years. One of the most important areas central banks are watching closely is core inflation. This excludes volatile categories like food and energy, and instead focuses on persistent price changes. And in many cases, core inflation has proven much harder to bring down. Why? Because it is tied to wages, housing, and services. After the initial inflation shock, workers across the world began demanding higher salaries, not because they were becoming richer in real terms, but because they were trying to keep up with rising living costs. This created what economists call a wage price loop. Businesses, facing higher labor costs, began raising prices to protect their profit margins. Those higher prices then pushed workers to demand even higher wages. And the cycle continued. Even when energy prices stabilized, this internal loop kept inflation alive in a more hidden form. Then there is housing. In many developed economies, rent and housing costs are one of the largest components of inflation. But housing does not respond quickly to interest rate changes. It moves with a delay. Sometimes that delay can be a year or more. So even after central banks aggressively raised interest rates, housing costs continued to rise in many regions. This creates a paradox. The medicine is already working, but the symptoms are still getting worse. Another critical factor is services inflation. Unlike goods, services are deeply tied to human labor. Healthcare, education, transportation, hospitality. These sectors don't benefit as much from global supply chain improvements. They are driven by domestic demand and wages. And services inflation tends to be sticky. It doesn't fall quickly. It lingers. This is exactly why institutions like the Federal Reserve, the European Central Bank, and the Bank of England have remained careful in their messaging. Even when markets expect rate cuts, central bankers often warn against premature optimism because they have seen this pattern before. And perhaps the most important historical lesson comes from the 1970s. Back then, inflation surged across much of the developed world. Energy prices exploded. Consumers felt the pain. Central banks responded. And eventually, inflation began to slow. The public breathed a sigh of relief. Investors became optimistic. Policymakers believed the worst was over. But it wasn't. Inflation returned. Stronger, more persistent, and more politically damaging than before. The reason was simple. Policy easing happened too early. Expectations were not fully anchored, and the underlying pressures in the economy were never fully eliminated. Today's central banks are determined not to repeat that mistake. This is why speeches from institutions like the Federal Reserve often emphasize the phrase, higher for longer. Not necessarily meaning rates will keep rising, but that they will stay restrictive for an extended period. Because the real goal is not just to lower inflation temporarily, it is to convince households and businesses that inflation will stay low in the long run. And that brings us back to expectations. Inflation is not only about numbers on a chart. It is about what people believe those numbers will be in the future. If people believe inflation will return, they behave in ways that make it return. If they believe it will stay low, they adjust their behavior accordingly. This psychological dimension is why central banks communicate so carefully. Even now, despite progress, there are signs that expectations are not fully settled. Financial markets often anticipate rate cuts earlier than central banks are willing to deliver. Consumers still feel the pressure of accumulated price increases from previous years, and governments continue to run large fiscal deficits, adding another layer of demand into the economy. All of this creates a fragile balance. On the surface, inflation appears to be cooling, but underneath, the system is still adjusting, still absorbing the shock of the previous years, still trying to find a new equilibrium. This is why many economists describe the current phase not as victory over inflation, but as a transition period. A moment where the initial crisis is over, but the consequences are still unfolding. And that is also why central banks remain unusually cautious. Because in economics, the most dangerous moment is not always when inflation is high. It is often when it appears to be falling safely, but hasn't fully stabilized yet.